Hi, and welcome back this morning. Kim Rubin from the Urban Institute and Tax Policy Center. I hope you joined us yesterday for a number of interesting sessions, sort of thinking about the questions of state and local finance and corporate finance and what it means. These issues seem especially pressing right now as state and local governments are facing new deficits and trouble as they go forward. This morning, we have a really interesting session that sort of looks at some of the actions state and local governments take and the costs they might incur, which seem especially pressing as we enter a new period of fiscal stress. I like all the papers that we're going to hear from. I'm going to give brief introductions. The other thing is there is going to be time for Q&A. We're going to try and do it after each session. So if you add any questions you have into the Q&A, that would be great. You could also add messages into the chat, but we're going to largely be doing things with the Q&A. So to begin, Manpreet Singh is going to talk about the impact of corporate subsidies on borrowing costs of local governments. Manpreet, welcome. And he is the Georgia Institute of Technology, as is his co-authors. Welcome.
Thank you. So should I start sharing my screen?
Yes.
Okay.
Please.
Is the screen visible? Just want to make sure, and you guys can hear me.
It is.
Okay, perfect. Thank you. So thank you, Kim, and thank you, Hawan, for organizing this conference. And so this is a joint work with Sudhir Chava, Baridi Malakar. He's a PhD student at Georgia Tech Business School. And this is myself, Manpreet. So in this paper, what we are basically looking at is the impact of corporate subsidies given by mostly local and state governments. How does it impact the borrowing cost of local governments? Okay, so let me make sure that my slides are working perfectly. Okay, so what we are doing in this paper is looking at the place-based incentives. Before I really talk about the place-based incentives, typically, local governments try to, or the state government basically try to put various incentives, which may include taxes like tax rebates and tax credits, various subsidies to the small businesses, large businesses, so that, it will encourage them to sort of do more economic activity in the area. And those economic activities, and the agenda is that because of the economic activity, there would be more jobs created, and that will also create some kind of economic development in the area. So one of the important ways more recently in last, I think 15, 20 years, which local governments are doing is basically they're targeting certain businesses and certain industries and providing them incentives so that these guys or these corporations come out and open their shops, their businesses, or their establishments, or their manufacturing units in that particular area. So I'm going to sort of talk about two quick examples. So one example is about the Kia plant, which opened in 2006 in Georgia, where I come from. So what happened is that the state and the local governments combined together, they offered around $410 million. And the objective is that these subsidies would help sort of encourage the Kia to sort of build up this plant, which cost almost like $1.2 billion. Okay, and the objective is that they're going to create around like 2,500 jobs. So that is one of the simple example. And more recently, exact NCR, which is like I think almost like 5 minutes walk from my house where I'm sitting right now. So they have a headquarter here now. And so they spend like $109 million, Atlanta City and state government together, to get NCR in our town. And this NCR is basically an ATM vendor. They had a location earlier. The headquarter was in Dayton, Ohio, and because of the subsidy, they moved out and from Ohio to enter Atlanta. So again, the point is that the objective is to sort of create jobs. And by offering these subsidies, these corporations come down into the area, and they're going to create jobs. So in this next figure, what I'm showing is that how much money these governments have spent. When I'm saying spending, it's mostly about future taxes which got rebated, right? So basically, if you have a future tax liability, so the government comes out and say you don't have to pay those taxes. So that's how these rebates are organized. uh, so these numbers are in $1 billion. So if you just look at that largest bar here, so New York has spent almost like $25 billion aggregate value from 2005 until now. And similarly, the next one is Louisiana, then Michigan, then Washington, then New Jersey, Indiana. So there are different states, and combined with their local governments, they've spent these many dollars to sort of attract plants. It's only in this particular kind of a program. So there are two basically views about corporate subsidies. So there is the proponent view, and I think I kind of briefly talked about it. Like using these $155 billion. This is just the total aggregate amount used in non-federal incentives, and especially in these corporate subsidies, has been spent by these state and local governments. And the objective is that they're going to boost the economic activity, and this is something we are facing even right now, that we are in the midst of a crisis. And then definitely I hope we'll get out of this soon, and then there will be importance to sort of create jobs, right? So then it becomes important to understand, like, are these incentives working or not? So we're going to look at the historical scenario to sort of see whether these things are working or not. And some of the important paper in this literature is by Moretti, and they argue that a one job created in manufacturing would create 1.6 jobs almost in a non-tradable sector. Well, similarly, a one job in high tech, you can think NCR, the example which I gave, is going to create like 2.5 jobs in non-tradable sector, which is basically your restaurants and your construction and things like that. So that's the proponents' view. While the opponents argue on the other side, what the opponents basically say that typically these subsidies are not given with very hard regulations. What I really mean is that there are no strings attached. So if I create jobs, while not that's not the case with all the subsidies, but there are a lot of subsidies which are not related to like jobs credit. Okay, some subsidies are like we're going to just give you tax abatements, which has nothing, where the correlation in terms of the jobs created is not much. Okay, if that's the case, then uh, the purpose is really not served. I think that's basically the agenda which the opponents have. And if you basically sort of think through like how does it work, that the jobs are not created, but at the same time there will be more people coming into the town, or there will be just increased burden on the public services, or the jobs which would be created will be like probably high skill jobs, and low skill workers are not really getting money or whatever, or there is an increase in the income inequality. So there could be a bunch of things you can sort of think through from the opponent's point of view. So one of the simple way to sort of think through is that there will be more people coming into town. You have to now provide public services, and there is obviously you have foregone part of the tax revenue. So which means that either you have to increase the municipal debt to sort of provide for these services, or you actually have to cut down the public services. When I'm basically saying public services, your road, your infrastructure, your schools. So all these things are, or your fire, your policemen. So all these things comes under the public services purview. So all these in all these activities, you got to have to cut down your spending. If there is not much increase in the economic activity. Okay, and at the same time, if that's not the way to sort of fulfill these services, then you probably have to increase property taxes. So these are the views which is given by the opponents. So there is this debate going on that should we have these targeted incentives, are they working or not, and things like that. So what we are going to do is we're going to just look at the muni bond market more particularly, and the reason, there are basically two particular reasons. So first is a really big market, almost 4 trillion debt market, and one third is almost owned by the local people. And second is that when you give these subsidies, right, there's a long gestation period. So you give the subsidy out, and the jobs are not created tomorrow, right? It's going to take a while, right? Which means that there's a lot of uncertainty about the level and the timing of particular investment and the jobs created and the types of wages are offered. So that becomes difficult to understand what's going on. So what we are coming from is from the finance perspective, which is a typical event study style regressions. So what we are basically arguing that if these subsidies are creating some positive value, then what you should expect is that these cash flows are, really coming from the bonds. So now, when these subsidies comes in, so there will be some kind of a change in the revenue, and that change in the revenue could be because of increased property taxes, more economic activity. So you'll probably get more corporate taxes, individual income taxes, higher fee-based civic amenities, multiplier effects. So all these things which are sort of positively sort of affecting the economy is going to create, more revenue for the local governments. While at the same time, because more people are coming into the town, so you have to provide for these services. So then there will be an increase in the expenditure, right? So that delta, that expenditure is going to be from the highways, infrastructure, water, sewer, power, communication, and all these things. And especially that subsidy amount, right, which is the foregone tax revenue, that will also be part of an expenditure. So now netting it out, so it's, if that's the case, that your future economic activity is larger than the amount you're still spending, it's basically a positive thing, right? So which, if that's the case, then which means that in the future you're expecting more cash flows. It's like very simple argument of a free cash flow for a firm. So now thinking really from the government's perspective, like free cash flow for or like extra cash flow for the muni government here. Okay, and then we are basically, all we are simplistically saying that if that's the case, then if this is a positive NPV project, then we should also expect that the local investors think positively about it, and they're going to cut down the yields, while so basically they're going to take this thing as a positive reaction. So prices for the muni bonds goes up, so the yields would go down. While if that's not the case, then the NPV, it's a negative NPV project in some sense, so therefore the yield should go up and the prices should go down for the local muni bonds. And when I'm saying local muni bonds, I'm basically talking about the county governments and not really the state governments, because state governments are really too big to sort of talk about this effect. So that's the reason we are really looking at the towns or the counties where these plants are basically going in.
You have 5 minutes
So
left.
yeah, sure. I'll just quickly finish off. Okay, so my main results, I don't think so I'll have time to show you all my slides, but I really want to get into the main results. So what we find is that there is an increase in actually in the cost. And if you really want to translate this is basically if you are really getting $131 billion aggregate investment, and you're paying a $38 billion subsidy. So you're basically paying, on top of the $38 billion subsidy, you're also paying $2.8 billion in additional cost, which is coming from your muni government. And we do a lot of stuff in this paper, but the basic thing I really want to talk about is we are comparing the winner versus the loser. So most of these subsidies are, there is always a winner with this, and there is a losing county. So what we are comparing is a winning county versus a losing county. And what we find is that on average, before the deal, there is no negative effect. While after the deal, you see that for the winning counties, the yield actually goes up. That's true also for the losing counties, but the difference is actually much expanded after the deal. So it sort of tells you the story. So let me just quickly talk about the key mechanisms. I will not have time to show all of these things, identification and stuff. So what I'm really want to talk about, what's the critical mechanism here. And what we basically talk about is that if the local government has, a good debt capacity. So if I'm not in a really bad shape, then that's not a problem. While if my economy is really in a bad shape, which means that I have already taken a lot of debt, there's a lot of interest that I had to pay, then that's the problem. So this is what we find here, that if your interest burden is really, really high, which is these high bars, so you notice that it's only for these local governments there is actually an increase, while for the governments which are not highly indebted, which is going back to the whole angle of debt capacity, can you really afford it or not, right? So we are basically saying that if you can afford it, then actually markets sort of think that it's fine because these economic activities are important, and therefore these place-based incentives could work. While if your government is already indebted, then market sort of things react negatively. Or another way to sort of say is that they're basically asking you more price for the extra money that you're raising from the market. We got something similar result when you look at high rating versus low rating. We have a lot of results in the paper. I think you can find it on the Brookings website. So this is one side of the picture, which is the debt capacity. Well, there is another side of the picture, which is that multiplier effect. Okay, so there are two forces working here, and if I can afford it, then it's fine. While at the same time, if the deal is really interesting, right? If we are getting plants or corporations, which are creating jobs, which is the ones which have a high multiplier effect, essentially, right? And this is where we also find some kind of an effect. And this is the way we are measuring this multiplier effect in two ways. So one is we are looking at the patents, another is looking at the multiplier effects. And we do find that these multiplier effects are really so the deals which have a high multiplier, there is a positive effect, or let me put it this way, the market sort of reacts positively to it. I think I'm already out of time, so there's a lot of implications on the local economy. So let me just touch upon like briefly in a minute. So what we also find something similar with the primary market. So all those results which I talked about is in the secondary market. We do see similar results in the primary market. At the same time, what we found is that the local property taxes actually revenue increases while there is no other change in the house prices. So and there is also no effect on the expenditure. So our hunch is that most of this financing is actually done by increasing property rates. We haven't gone there yet, but that's what our hunch is, because what we do find is that there is so the governments which had a debt capacity, they could raise more money while the others could not, and they may have to sort of resort to the local property taxes. So let me just conclude here that there is an additional cost when you basically provide these subsidies on top of the subsidies which is coming from the increased borrowing cost. And this is basically a lower bound, which is 2.8 billion, because we are just putting all the deals together. So while for some of the counties these numbers could be really high. Okay, and what we are basically saying that the counties with lower debt capacity or a lower bargaining power relative to the firm, I didn't get a chance to talk about those results, do face a higher borrowing cost. And similarly, counties winning the deals with a higher multiplier effect actually experience a lower borrowing cost. Thank you for listening to the presentation. I'm looking forward for Donnie's discussion.
And now Donnie Charleston from the Urban Institute and Tax Policy Center will discuss that paper.
Good morning, everyone. Thank you for having the opportunity to participate, Kim, and the people who organized the panel. It's a pleasure to be with all of you virtually today. First of all, I just want to say I thoroughly enjoy reading this paper, and given the volume of stuff we all have to read, we don't always get to say that. So given just the sheer volume of academic research that we consume on any given day, this particular research, I think by virtue of its focus on bond markets, fills a definite void in the literature. And it's noteworthy the connections it makes, not only on the literature around evaluating tax incentives, but the literature on the relationship between taxes and firm innovation. So I think that's definitely something we should take note of. But it also helps fill a knowledge gap for policymakers and economic developers who are actually responsible for weighing and executing these tax incentive deals at the local level. To say that these professionals operate with imperfect information is an absolute understatement. So this research takes a step towards helping to fill that information gap in some ways, not only for the communities, but for bond market professionals as well. Potentially, I was also struck by how the research in some ways is providing a little bit of almost like a backdoor insight into bond markets and potentially how these entities operate with different standards, rating methodologies, and how they weigh different factors differently. And so I think that was also very noteworthy for the research. And in that way, it raises questions about the imperfect information that the markets are operating with as well, and the implications for county governments and state governments, local governments, from the standpoint of what they have to pay and the costs that are borne by those entities. I won't rehash the author's main findings. I think he did a good job of summarizing that towards the end. But I do want to highlight a few caveats regarding the methodology. I think it can point the way towards future research in this area. The first of which applies to the use of the counterfactual that the researchers use. They are operating from the position that there's actual competition between the winners in the bidding process and the run-up community. So they're using the run-up community as a comparative for the difference in difference analysis. However, I think that it's imperative that we take into consideration the actual nature of how these deals play out and how firms navigate this space. We have very little insight into the actual decision-making process of firms. But we do know that, and there are documented cases, court cases and so forth, of firms deciding their locations and then pitting competing communities against one another, even though they've already chosen where they want to locate their firm or make their investment. Given that reality, it raises some concerns about the validity of the counterfactual in and of itself, and were those comparison communities valid comparators in the first place. Admittedly, that's not just a challenge or critique of this research, but any research in this area, given that black box dynamic that we don't really have insight into. The researchers actually do make efforts to kind of deal with that regarding their assumptions on the county pairings by assessing economic trends in the communities before the deals. They rely on unemployment rates, level of change in the labor force, house price indices, and personal income. This helps provide a baseline of similarity between those communities, which is a definite value add. And arguably these factors are, however, factors are somewhat probably too broad and not specific enough. In particular, specific to the actual factors that we know firms take into consideration and that are of prime importance to them as they weigh their decisions, like educational attainment in a given community, presence of institutions like higher education institutions, infrastructure in a given community, highways, airports, and so forth, and quality of life factors. By not including those as comparatives, I think that could complicate, how the research itself. That takes me to another concern, which is unit of analysis. The researchers relying primarily on the county and state as their units, but the reality of incentive packages is really one of layering the benefits at the state, county, and city level. So we're potentially missing a key part of the data picture in the context by just focusing on counties and states. This is noteworthy in part because the paper's analysis of the relative bargaining power of the communities relative to the firms. By focusing on the state budget surplus and not assessing the city and county factors related to bargaining power, we may not have a full picture. The fiscal performance of states is in many cases disconnected from that of its local communities. Highly solvent and productive cities and counties function in states with relatively poor fiscal measures at the state level and vice versa. So I think that's something to take note of. But notwithstanding all these caveats, I want to reiterate the value of this work and the contributions it makes to our knowledge base. From a practical standpoint, which is where I try to focus most of my attention, this work has the capacity to really help governments evaluate their own protocols and approaches to constructing incentive packages. Local leaders are in desperate need all over the country of research like this that takes a step towards identifying clear metrics that they can use to project the cost of deals to their community, in this case, borrowing costs, beyond crude measures like the cost per job, which we know is a problematic measure. And it also provides more information for leaders in that it illuminates the relationship between factors that were the subject of guesswork. The firm behaviors that target buy incentives, interest rates, and government fiscal performance, that whole dynamic between those three variables. The plethora of incentives on the books of states that I'm sure many of you are aware, and localities that fail to address this nexus between the goals that communities are seeking, like job performance, and the incentive structure is just truly astounding that we don't have that states and counties and cities don't have good insight into that dynamic. And to that point, as we move increasingly to more and more engaged citizenry that is hungry for information and capable of synthesizing data and information regarding deals, research like this helps us bridge the gap between crude measures and indicators that are more two indicators that are more what I call citizen proximate. Whereas citizens care about things like tax rates. They care about the operating budget and the relationship between tax rates. So I think this really helps us bridge that gap for individuals and citizens. We're talking about participatory budgeting and so forth. I think this is definitely a step in the right direction in that regard. Lastly, given that we're all operating in a new normal due to COVID, as Kim mentioned, it's incumbent that we look at this work through that lens. It remains to be seen how the economy will perform in the next few years, but evidence from the Great Recession shows that how firms accelerated investment in automation as we emerge from the recession. And we are already seeing indicators that this trend will be the same. Meat processing and in hospitality and leisure, we're already seeing firms do research and investment in automation to deal with this whole new reality in terms of how businesses need to operate within a new normal. The implication being for this research and this research area is how will those trends impact bond markets assessment of the potential impact of a deal vis-a-vis job creation potential. So the incentive that firms have for investment in automation because of TCJA and now the CARES Act, which added increased incentives, may only spur that trend. So there'll be some serious implications potentially for how markets evaluate those incentive deals, and then the implications for the cities, counties, and states, and their interest paid and the return on those investments. But that's the extent of my comments. And once again, I thoroughly enjoy reading the paper, and I look forward to any questions.
Thank you. Thank you, Donnie. So we don't have any Q&A in. I'm gonna remind the listeners or people watching that if you want to pose a question, you should add it to our Q&A. I have a question for you, Manpreet, and part of this
Yes,
is
Kim.
building off of what Donnie was saying, and I'd love to get your thoughts on it. So can you say something about whether you think that there's differential or places should think more about whether these deals and what it will mean to the bond markets in periods when they're doing well versus when they're doing poorly, right? It feels like during periods when you're booming, if you're trying to grow your economy, giving up some of your revenues might be easier than right now when there are all these other competing requirements, and there might be other reasons that you're going to need to borrow to go forward.
So I think the way I posed my presentation also, right? I think I'm not completely against these corporate subsidies, while I'm also not a pro sort of, I'm sort of somewhere sitting in between. And the reason why I'm sitting in between, and especially when going back to these times, right? Like when you're a booming period, I think if I just look at the data period I'm really talking about, so 2010 to 2018, that's most of the time we are really looking at. And we do see that because that was like we were coming out of the previous crisis. And we do notice that, the state governments and local governments are pushing harder to sort of, again, I think that was also the similar time, right? There were sort of these demands the governments had from other competing sources. On top of it, this foregone revenue. And what we notice is that definitely there is an improvement in the economic activity and everything, right? But I think the trade-off that you really have to sort of think through is that how big is the job multiplier and what kind of jobs are getting created, right? So I think the reaction that we found is that if these jobs are really innovative, they are in high tech sector or whatever, right? So then your expectation is that they're going to create some kind of a spillover effect if there is, and at least market believes that. Okay, so there is a big debate on whether those spillover effects actually present or not. Okay. So you can always keep a discussion on that and say, okay, I don't believe these spillover effects. The multiplier, I don't believe in those multiplier numbers. But I think my argument is going from the market's perception, and the market perceives that if these deals are more innovative, or basically you are getting corporations which are doing more R&D and they have a lot of patents. So there is a perception and that there is going to create more jobs in the area, and you have to believe in the markets. That's how, right? And then you basically sort of say that yes, it does value to the economy, while at the same time, right? So there again another debate comes in, is that okay, we're going to create jobs, but these are going to be high-tech jobs. What about the low-skilled workers? What about the manufacturing guys? What about the others? I think that's where the problem's going to be.
And in your study, were you able to differentiate between what some of the incentives were? Like, you could imagine that there's a big difference between, say, trying to give money to get a Tesla plant there versus give money to get a new meat processing plant there. And
yes, so,
right, because there are the differences in types of jobs, but then there are also the differences in number of jobs. Like some of the critiques I've seen, and Tim can probably get into this somewhat in the next session, like some of these high-tech incentives might not actually be creating very many jobs if they're actually doing something that is more automated. So right. Were you able to differentiate between some of the specifics about?
We did not get into the specifics of automation or like number of jobs as such. We do look at promised jobs. That's the problem, right? Okay. Promised jobs versus the jobs created is a completely different deal, right? I can go ahead and sort of look at the cross section and say that, look, these jobs being promised, but at the end of that, I think this is where Kylene papers comes in, which is the next paper, right? Which really talk about the real jobs created. So I think I'm just taking the perspective of the market, what the market reaction would be given the ex ante beliefs on certain type of industries, right? So if you have a belief that these high-tech jobs, and assuming that those spillover effects would be coming in from these things, market at least perceives that, you know, I'm going to give you a rebate on these subsidies in some sense, right? I'm going to charge you less for the future borrowings. Yeah.
All right, great. And on that, we'll transition over. That's a great segue into the
I
work.
just want to thank Donnie for his comments. Thank you, Donnie, for reading the paper and, you know, for your helpful comments. And I'm not going to talk about all these things. I think all these are valid points, and we should look into the counterfactuals. Thank you.
We have a question in the Q&A, by the way.
What?
We have a question in a Q&A, by the way.
Okay, can we come back to it at the end?
Sure.
All right. So Kaylin Slattery is going to present work from Columbia University, is going to present work that's joined with Owen Zadar from Princeton, evaluating state and local business tax incentives.
Great, thanks so much for having me. As Kim just said, this is joint work with Owen, and we are going to follow on directly from what Manpreet just presented on and talk about state and local business incentives. So, as you may know, state and local governments spend billions of dollars each year on tax incentives and subsidies to attract and retain firms. And these policies are highly controversial. So even though we can agree that attracting industrial activity is key for local economic growth and prosperity, many question the incentive spending, effectiveness, and mounting costs. So in order to evaluate these incentives, we basically need to overcome three issues. The first is just data. State and local governments vary widely in what they report and how they report it in terms of these incentives. The second is just a lack of transparency in how governments decide which firms to target and how much to offer. And the third is that, of course, we don't observe how economic activity would have evolved in the absence of these subsidies incentives, right? So I collected data on these incentive programs for my job market paper, and we're going to use that data in order to make progress describing these policies and evaluating them a bit. So what we do in this paper, and what I'll try and briefly show you today, is we characterize the incentive policies, we describe the selection process that determines which places give incentives and which firms receive them, and we evaluate the economic consequences and discuss policy implications. Now, like Manpreet introduced, the reason that state and local governments say that they give these incentives is to stimulate the local economy and create jobs. In the paper, we provide a framework to evaluate different types of incentives, the different instruments they use in order to do this. I'm not going to be able to go into the framework today. I'm just going to introduce the three instruments that we're going to consider and really focus on one. So the three instruments that we consider are all in the tax sphere. You could lower the corporate tax rate, right? This lowers the tax bill for all C corporations in the state, and the goal is to encourage new entry of firms and expansion of existing firms. You could also narrow the corporate tax base by, offering a tax credit that targets a certain industry or activity, such as the R&D tax credit. So this would encourage entry of firms in that industry, maybe increase this target activity. And then third, there's the offering the firm-specific tax incentives that we already learned about this morning. So you offer one firm a subsidy for their commitment to locate in your jurisdiction and create a certain level of employment and investment. What we see in the data is states are really doing a mix of all these three things. There's a lot of heterogeneity even within states over time. So for example, we can see California has a high corporate tax rate, offers a significant amount of tax credits, and offers a decent amount of subsidies, where the cost per job on these firm-specific subsidies is fairly low relative to other states. Their neighbor Nevada has no corporate tax rate, then they can't offer any tax credits. They have some other economic development spending. This may be like job training grants, things like this. And they don't offer many subsidies, but when they do, the cost per job is a lot larger, right? And so part of this paper is just trying to understand the data, understand the different incentive instruments states have, and when and how they use them. For the rest of the talk today, what I'm going to do is just focus on these firm-specific tax incentives that states and local governments are offering. Now, why might we want to offer a firm-specific tax incentive? Well, the first and most common thing that you hear is that, well, I want to attract a high benefit firm, right? I know this firm is going to, hire a lot of workers, have a great spillover effect in the economy, increase demand, increase productivity of incumbent firms. This is a high benefit firm that is going to transform my local economy. Why else would I offer a firm specific tax incentive? Well, I can contract with the firm directly on investment in hiring, which, that's not the case if I'm just lowering the corporate tax rate. I don't have to lower revenue collected from all firms in the state as I would if I lower the corporate tax rate again. And fourth, I could target mobile firms, raising revenues more efficiently. The fifth point is about using these subsidies for retention. So I could, convince a firm to stay in my locality if they have, a network of suppliers in my locality that may be really harmful for the local economy if I lose that firm, right? So those are all kind of what we think about as the pros or the benefits to offering firm-specific tax incentives. But I think we all realize that there are also a significant number of costs. The first is just the corollary to attracting a high benefit firm. It's really hard to determine which firm is going to be that high benefit firm, right? I think as economists, we all know that it's super hard to estimate agglomeration effects. So how am I going to know exactly what the effect a firm is going to have on my local economy? I also think that it's hard to know if the firm is really inframarginal, if they would have located in my locality without the incentive. Third, the lack of transparency in the incentive giving process or the subsidy setting process leaves incentives exposed to political capture. There was a series of articles in the New York Times recently about New Jersey's issues with corruption in the subsidy giving process. And fourth, something that we see in the data is that most distressed places may not be able to afford to compete. So the place that may benefit the most from attracting a firm just doesn't have the capacity to put together an incentive to attract that firm to that place. And lastly, providing generous incentives requires raising revenue from other taxes, as we've learned a little about already. So now that we understand kind of the trade-offs and the firm-specific tax incentives, I just briefly want to go through what do we mean by a firm-specific incentive, although this is maybe a little repetitive now. So in 2008, Volkswagen chose to locate their new auto plant in Chattanooga. They promised they're going to create 2,000 jobs at the plant, and they were going to invest $1 billion. In exchange, Tennessee grants Volkswagen a subsidy worth almost $600 million. This is a function of property tax abatements from the local government, state tax credits, and then some in-kind incentives like property and construction, rail line upgrades, things like this. Tennessee projected that Volkswagen would have $100 million impact on annual payroll, which seems reasonable, and then help create 14,000 total jobs. So 2,000 jobs at the plant, 14,000 jobs in total is a multiplier of about 7, right? Having a total economic benefit of $600 million per year. So what we're trying to understand is what actually happened in Tennessee once Volkswagen located there, right? How we're gonna do this, the same strategy that Manpreet used, we're gonna consider the runner-up in the competition for Volkswagen as the counterfactual, okay? So we read articles about Volkswagen's location decision. They say it's truly a very close competition. They hired a site selection firm and they considered more than 100 candidate sites. The runner-up in Huntsville, Alabama, which is 2 hours away from Chattanooga, offered about $400 million at least. And so what we can do is compare employment in the sector or related sectors in Huntsville with the employment in Chattanooga before and after the subsidy deal. And this is what we see here. So employment in Hamilton, Tennessee, which is where Chattanooga is located, after the subsidy deal in 2008, in transportation manufacturing, which includes auto manufacturing, increased by over 2,000 jobs, which is the number that they promised. And if you difference the winner and the runner-up, the number is almost 4,000 jobs. Okay, so what we're going to try and do for the rest of the talk is, this is a case study. This is just what happened in Volkswagen, in Chattanooga with Volkswagen, which is actually hailed as quite a success story. It's yeah, and so we're going to take this to the data, collect data on many incentive deals, and do this analysis all together. Okay, so where's the data from? We have firm-specific incentives between 2002 and 2017. This is just a snapshot of what the data would look like. So we know the company, the year that the subsidy deal was agreed on, the winning county, and the runner-up. We also know the size of the subsidy, the number of jobs promised and investment, and some other variables. The sources are the Good Jobs First subsidy tracker and the site selection magazine. I use that to kind of compile a universe of subsidy deals, with the sample selection being that they are at least $5 million, because the smaller deals, there is a lot of selection and measurement issues there. Then I read out the articles on each subsidy deal and supplement with the state tax expenditure reports and state budget documents to figure out if they qualify for any, tax credits and things that are not mentioned in the article, the subsidy deal. At the end of the day, this gives us a sample of almost 550 subsidies. The average subsidy size is $178 million, and on average, they're promising 1,500 jobs. For about 400 of those deals, we know the runner-up county, and we know that there was we are fairly confident that there was some competition for the firm.
In about 4 minutes.
Thank you. So let's just describe the data quickly. Most subsidies are going to manufacturing, technology, and high-skilled services. Automobile manufacturing is the most popular. It also has the highest expected multiplier, which is consistent with this idea that policymakers are targeting firms with large agglomeration effects. The second thing we see is that subsidies go to large establishments from large profitable firms. Part of this could be the sample construction. We're selecting on larger subsidy deals, but still the majority of establishments that enter the US are small, and the majority of establishments that get subsidies are very, very large. We also look at the firm characteristics by linking our data to CompuStat data and see, compared to other publicly traded companies, subsidized firms are larger and more profitable. Okay. And lastly, I'll tell you one thing about the type of places that offer subsidies. We find that low wage locations provide more generous subsidies. This could both be because they would benefit more from attracting the firm, or because they're a less attractive place for the firm to locate, and then they have to offer more in order to compete with more attractive locales. This figure is conditional on winning a subsidy deal. So we see that the poorest places are never winning this subsidy deals. So now that we have the data, we understand a little bit more of the selection process, we can show you the effects. And this is the event study figure, where on the x-axis is the year since the deal, and on the y-axis is the employment in the sector of interest, in the industry of interest, the 3-digit industry, sorry. And basically what we see here is that employment increases by about 1,500 jobs. So we're picking up that direct effect of the subsidy deal, right? On average, the subsidy deals were promising 1,500 jobs. When we try and look at the spillovers, so look at the residual in the industry, not in the specific industry of the deal, we don't find very much. So we're not finding much evidence of any spillover. We're picking up that direct effect of the jobs promised at the plant. Of course, this is on average, so it may be that some firms don't even create as many jobs as they promised, and some, like Volkswagen, created a lot more. I'll just briefly note that, you know, previous studies have found more support for spillover effects using establishment level data. And we want to make the point that our data is selected on subsidy size, where their data was selected on size of investment. I think that can explain a lot of the difference in the effects that we find. Now, in the paper, we talk a lot about the national perspective and the difference in what the policy prescription would be between the state and the national. And let me just take a couple minutes to briefly talk about policy more generally. We think that policymakers can design incentives with equity considerations in mind. You know, if we're not finding much evidence for these spillovers, there is an argument for giving subsidies based on, you know, improving equity. But there's almost no work on it. We know very little. We want to target tax incentives to hard-hit regions, subsidize employers who promise to hire local residents, or target marginal investments in job creation for high multiplier industries, which would be more transparent and less political than incentives for individual firms. We should also evaluate whether these incentives actually trickle down. So in general, we think we need more rigorous evaluation and transparency requirements, and that would help us make a lot of progress in evaluating these subsidies more systematically. You know, there has been various calls to harmonize across the nation. You know, there has been some small regional harmonization in the last year. However, there's a debate on how well this is working. And also there's, I think, a lot of room for discussion of a larger super federal role, which is basically the policy in the EU. And I think I'm probably out of time, so I'll just go to the last slide. There are a ton of open questions in this area, and I really want to encourage more work. And I will just leave this slide open so you can read it and say thank you so much for listening and inviting me to give this talk.
Thank you. We can leave this slide up or not, as Tim Bartik from Upjohn is going to discuss this paper.
I can close it. The slides are on the website, so you can see the slide there.
Yes.
Okay. So this paper, well, first of all, I want to say it's an outstanding paper. If you have any interest in economic development incentives, you should read it. Reflects a tremendous amount of data work and very hard data work. And as a result, they're able to come to some findings that I think are new and that deserve some further investigation. And I think there's some important policy implications of what Kayla and Owen are finding. The first point I want to really emphasize and come back to is when you look at their numbers, at least for some subsidies, they're extraordinarily large. So we're talking about incentives that amount to about 20% of the dollar value of the investment on average, 20%. And the amount per job is 120,000 per job. So clearly it exceeds average wages per job, at least 1 year of average wages. And other people have found large incentives. This paper finds even larger incentives. So it points out that at least in some cases, we have extraordinarily large incentives. So we need to think about that. The second thing they find that they really move the research literature forward on is these incentives are disproportionately awarded to large firms. I think people suspected this, but this is better documented that than any other research I've seen. So we're favoring large firms with these incentives. We're having a policy of favoring large firms. Implicitly, maybe not deliberately, but that's what we're doing. They also do a really interesting welfare analysis of incentives that deserves further work. I mean, essentially, in terms of the multiplier discussion we were having earlier, they find a multiplier of 0. Or if you actually take the point estimate seriously, they find a negative multiplier sufficiently to offset the initial direct effect. Now the estimates are imprecise, but essentially firms that, areas that are winners, there's no sign that their overall employment is any higher 5 years later. At least you can't reject that hypothesis. Now, I really think that deserves a lot of additional research. I mean, one thing I do want to note is that even the direct effect in the 3-digit industry doesn't necessarily, the fact that the winning area compared to the runner-up is doing better in the industry that they attracted doesn't mean the incentive caused that. I mean, something caused it. I mean, who knows what? It could have been the infrastructure of the area, it could have been public services in the area, amenities, or it could have been the incentive. But the fact that employment went up directly in that 3-digit industry doesn't mean the incentive caused that. But then when you look at this displacement effect, or whatever you want to call it, that outweighs the multiplier, I think it's important for us to think about, well, how could that be? So in simulation work I've done, and if you do regional econometric models, if you would expect some multiplier effects as well as some displacement. Okay, so we have some multiplier effects due to input-output effects. And then we have some displacement due to, for example, higher wages, higher land prices when we attract firms. And if you plug in conventional elasticities, you might get about a 1/3 reduction in the multiplier due to that. And that's consistent with some work I've done on multipliers as well, that multipliers seem to be empirically about 1/3 lower than you'd expect from input-output models. So, like that VW case in Chattanooga, if you thought the multiplier should be whatever you thought, I'm going to ignore what the state said it was going to be as completely ridiculous. But let's say you thought the multiplier would have been 2.4 due to input-output effects on suppliers and retailers. Higher wages and rents might repel other firms, and you might expect the multiplier to be 1.6. The question is, how on earth can we get a multiplier of 0 or 1 or even 0? One possibility is that our conventional models, where we model displacement effects as being only due to higher wages and prices in the area repelling firms, maybe we're not capturing some non-price effects. So when VW moves into Chattanooga, maybe it picks the prime industrial site in Chattanooga, and that squeezes out other firms, and that effect goes beyond any effect on land prices that we might measure. Or maybe VW soaks up all the prime industrial labor. And again, maybe that effect on other businesses goes beyond anything we capture in some wage index we come up with. So I think this really deserves a lot more research because the amount of the multiplier is not just something of interest to input-output modelers. It's of interest. It should be of interest to a variety of people. The other thing I want to point out is the policy implications. Caitlin mentioned the EU. And let me talk about the EU rules. So they document again that the average incentive, at least among these large incentives, is 20% of the investment over a year's worth of salary. In the EU, in general, for most of the EU, you can, for large projects, you're not allowed to have an incentive of over 3.4% of the investment, 3.4%. Or 3.4% of 2 years of payroll, which would be 6.8% of 1 year's payroll. So judging from the investment one, the average incentive in the US is over five times what most of, say, the EU is allowed to have. Now, in more distressed areas of the EU, like Bulgaria, and some regions within countries where they're distressed, they can have incentives 5 times as great as that, around 17% of the investment. So essentially, the average incentive in the US is slightly higher than the incentives that the EU only allows in the most distressed regions. Whereas the more typical incentive in the EU is 1/5 the level. And so I think we need to think about, could we have some kind of federal regulation of incentives that would ratchet down the size of these incentives somewhat, at least in non-distressed regions, because the EU seems to have this regime. It allows for incentives, it allows for higher incentives in distressed regions, but it doesn't allow for some of these ridiculous incentives that we see. And I would say that if we wanted to really do that, one of the things that Caitlin's work points out is that this goes to large firms. There are only 1,500 firms in the US that are greater in size than 10,000 employees. They're about 30% of total employment, but they probably, based on these findings, get 80, 90% of incentives, if not more. And in my view, if we simply said for the largest 1,500 firms in the US, that in general, they can't receive incentives that exceed, I don't know, 4% of the investment, 5% of the investment, you know, and then maybe if it's a designated distressed area, they can get 15 or 20%. We could probably cut down the volume of incentives in the US by over $10 billion a year. I still think we'd have more effect on distressed areas. So I think we need to debate, based on these findings, how we target incentives and how we regulate them. So let me stop there.
Thank you. Caitlin, I don't know if you want to respond to what Tim said. I feel like the points you're both making are really important. I just kept finding myself thinking about something like what we saw with the whole Amazon HQ2, where there was this huge competition. In the end, New York basically turned it down, and it sort of pointed out the fact that if the winners in some of these things end up being the places that least need it, is there really this fear of crowd out? Like I was just wondering whether what we're seeing and the reason you didn't have a spillover effect is if you have a limited number of people and you don't have the ability to come in as much, whether you're actually taking it out of related industries or something.
Yeah, that's possible. I think it's hard to some of these multiplier effects are hard to pick up given that we're using this county level data. And if we have the establishment level data, I think I'd be able to say that with more confidence that, like, yes, it's this mechanism versus that, or yes, it is crowd out or it isn't. But I think that is definitely possible. And if we looked at the subset of the data where it was maybe the slightly more distressed places, that had high unemployment places that were getting in, and see if we see higher multiplier effects there, we may be able to say something to that degree. But yeah, it's a lot of the big cities whose economies are doing well that win a lot of the subsidy competitions. Yeah.
Okay, and we just got a question: to what extent are job-specific incentives substitutes for other types of incentives, or restricting them would lead to other types of competition? So do you think there are trade-offs between offering the specific incentives versus something like lowering taxes? Or in some of the work we've done, we've actually found that there are more effective ways to try and attract businesses, especially if you want new businesses, in terms of offering things like financing help or, setting up incubators or something.
Yeah, so some of these incentives include things that are not job specific, investment incentives, things in those nature. We don't know that much about the trade-off states make between, deciding to be high corporate tax and tons of subsidies versus low corporate tax and no subsidies. And I think that's a rich area for future research, you know, kind of really, really thinking about why some states choose one strategy versus the other, and what the trade-offs are.
Let me weigh in on that a little bit. I would say there's definitely a trade-off, but I would think that what you could do, for example, even if you wanted to simply do incentives, is why not have a general investment credit for new facilities or expanded facilities in export-based industries. And if you had that, you could accomplish a bunch of the goals of incentives without discriminating against smaller firms. I think the problem with these discretionary incentives for large firms is that state and local areas are tempted to overbid because of the overwhelming political and media attention to these large deals like Amazon or VW. I think a governor wanting to get reelected is really tempted to, well, frankly, to give a large incentive to VW or Amazon, even if they know for a fact that's not needed.
Right. Yeah, I agree. And I find that in other work that, you know, when the governor is up for a re-election, they're willing to spend significantly more on subsidy deals. So yeah, I agree.
We need more rule-based incentives. I mean, you know, we should be living in a society, perhaps recent political events have convinced us even more. We need to live in a society that's based on rules, not discretionary power by executives.
And yet, I'm going to say we're going in the opposite direction. But
Well,
so Owen had a question for Manpreet, which if you can answer quickly, we'll do that before we go to the last paper, and we can go a little longer before the plenary session. So Owen's question for the prior paper was, can you say something about the size of the effects, and especially about how the financing costs relate to the annual revenues, for example?
Yeah, so we didn't really look at compared to the annual revenue, but we did look at just based on the previous cost percentages. So the average effect is actually low, not huge, right? It's almost like 3% of your previous borrowing cost. But if you look at these subgroups, right? Like if the county is already in a trouble and had a higher borrowing cost and these interest payments due, their average cost could actually go up like 7 or 8% compared to their baseline. So that's basically, you sort of think through this. There's a huge heterogeneity. And going back to, I think, what Tim was saying, right? That some of these places are already in a really bad shape. They really cannot afford. That's the reason why these costs are increasing. But again, the results that we have versus what Kylene has in terms of jobs, one has to sort of look at very differently, right? So our results could be like more of like, you know, if you do end up paying these costs in terms of higher subsidies, then like how much do you pay on top of this, right? Like, do you just pay the subsidies but also pay the borrowing costs? So let me just end here.
Right. Okay. We're gonna switch gears a little bit and look at a paper that might be a cautionary tale about what happens if you have too many incentives and you end up in bankruptcy. So we're now going to hear from Akil Singla and Carolyn Abbott. Akil is from Arizona State University and Carolyn is from St. John's University on capital investment, service solvency, and quality of life after municipal bankruptcy. So less incentives, more trouble.
Thanks, Kim, for that introduction. So I just want to start off by reiterating, my name is Akil Singla. I'm an assistant professor at the School of Public Affairs at Arizona State University. And my co-author on this project is Dr. Carolyn Abbott, who's also an assistant professor at the Department of Government Politics at St. John's University. And we're going to be talking about municipal bankruptcy and specifically what happens to service delivery. So whenever we talk about bankruptcy, we're inherently talking about fiscal stress that local governments are facing, and not necessarily even run-of-the-mill fiscal stress. Like, I think we can pretty credibly say that right now all local governments are facing fiscal stress, but extreme fiscal stress. And so one of the things, if you study this area, or even if you're sort of a casual observer about fiscal stress, is that there are a lot of different causes, but not many solutions. So extreme fiscal stress can be caused by something like a recession, like we're experiencing now. It could be caused by more structural concerns in a local economy, so closure of an auto manufacturing plant or some other structural change to the local economy. Could also be caused by different financial management choices, so large amounts of pension obligations or outstanding debt, or it could be caused by some combination of all of those factors. And irrespective of the source of the stress, there are only a handful of solutions for local governments. And I think the main reason for this is that local governments face hard budget constraints. So unlike at the federal level, where the federal government can operate at sort of perpetual deficits, at least for the last 20 or so years, local governments can't do that. So most of the discussion about what to do in response to fiscal stress comes down to three choices: raise revenues, cut expenditures, or rely on rainy day funds. And so there aren't a lot of solutions. What we're looking at in this paper is something that's understudied, which is Chapter 9 bankruptcy. And so I want to give just a little bit of background about what exactly Chapter 9 is. So broadly speaking, there are 4 eligibility criteria for Chapter 9. Chapter 9 is the section of the Federal Bankruptcy Code. The first 2 eligibility criteria are the most important. The first is state authorization. So local government needs to be explicitly authorized by a state in order to file for bankruptcy. And so half the states have some form of conditional authorization. And the second is that a local government must be insolvent. So, and the statute defines that as being unable to meet its obligations as they come due. And there's a little bit of leeway there in recent court decisions for not necessarily just financial obligations, but potentially service obligations. The other 2 requirements are that a local government must desire to adjust its obligations or its debts and be unable to negotiate with creditors. And so not all local governments meet these criteria, but certainly some or potentially even many do. So irrespective of the number of governments that maybe meet these requirements, Chapter 9, we know for sure, is historically extremely rare. And part of this is that default rates among general purpose governments in the municipal sector are very low. So in the bond market, we're not seeing a lot of defaults. And though default and bankruptcy aren't the same thing, they're certainly related. And so in the last 15 or so years, we can say that there are probably 7 or 8 cases of Chapter 9 bankruptcy. And so that's not a lot when you think that there are sort of 45,000 general purpose governments in the United States. But even that number, 7, is actually quite a bit higher than the prior 15 years. And so we might have some evidence that Chapter 9 is becoming more common, in the post-Great Recession and potentially in the COVID-19 era. I think there's a local government in Alabama that recently just signaled that it was going to file for Chapter 9. So, okay, so local governments are fiscally stressed. Some are extremely fiscally stressed. Chapter 9, why do we care? What's the relationship? Well, Chapter 9, there are some pathways by which bankruptcy can allow local governments to improve their standing, fiscally at least, potentially also in the service area. But I'll start off with the fiscal side, which is basically that the Chapter 9, when you're in the bankruptcy process, you get an immediate stay on payments to creditors, and you can reject existing contracts. So that includes collective bargaining agreements, and it also includes long-term debt. And so that plus the threat to creditors that the judge will force creditors to accept a settlement via a process aptly called cram down generates leverage for local governments. So Chapter 9 actually has some pretty strong pathways by which you can improve the financial situation of a local government. Now, what does that mean for residents? That's really what we're interested in our work. Chapter 9, municipal bankruptcy, provides pathways by which a local government could improve its financial standing. But if that comes by cutting services to the bone, that may be bad for residents. And so if the legal process is primarily focused on the financial considerations, we don't necessarily know what that means for service delivery. And so our research is focusing on this idea of service solvency. So are local governments providing adequate services to their residents, and how do they use Chapter 9 to affect that? I'll note that this process, service solvency, is extremely difficult to measure, and that we are going to focus on crime, and Carolyn's going to talk a little bit more about that, and also more generally what we did. So I'll hand it off to her.
Great. Can you hear me okay?
Yes.
All right. Thanks so much, Akil. So Akil did a great job describing our theoretical framework and our central research question. I'm going to be describing how we tried to answer the question empirically. So the first thing we did was create a data set of municipalities that filed for Chapter 9 and a data set of very similar municipalities within the same states that did not file for Chapter 9. And we were able to do this by leveraging a very large comprehensive data set from the United States Common Sensus GovRank project. This project compiled audited financial data from over 8,000 municipalities between 2009 and 2014. So we used a matching algorithm with this data to find variables that were most likely to predict bankruptcy. And these turned out to be the net asset ratio, the operating ratio, the size of the municipality's population, and the density of the municipality. Using those variables, we were able to find other variables that were very similar on these 4 dimensions. And those, in a way, could act conceivably as a comparison group to the bankrupt municipalities. And I'm going to show you on the next slide the results of the algorithm and the municipalities we used to form a control group. Next slide, please. Thank you. So we chose to find 5 control municipalities for each bankrupt municipality. This is a kind of an arbitrary decision, but I can just tell you that expanding the size of these control groups doesn't really affect our standard errors or our power. The largest determining factor in that is the size of the treated group, the municipalities that actually filed for protection. And that, of course, we're very limited in examining. This might change, as is Akil discussed earlier, given the current economic climate, the possibility of new municipal bankruptcies. But right now, this is the situation. These are the number of treated observations we have to work with. We're also limited in that we wanted to compare bankrupt municipalities to similarly fiscally distressed localities within the same state. And so this meant that we were drawing a lot of control observations from California, which is where half of the bankruptcies occurred. But we also had to look within Rhode Island for cities and towns that were very similar to Central Falls, even though there aren't really that many towns and cities in Rhode Island to begin with. So given that and all of our limitations, we were pretty pleased with how well the balance of a number of different variables improved once we ran our matching algorithm that I can talk more about in the Q&A if anyone is interested. Next slide, please. So once we settled on our data set and list of municipalities, we set out to collect the data that would allow us to compare a variety of different outcomes for these fiscally distressed local governments. We collected a number of different line item expenditures, including total and general fund expenditures, public safety, parks and recreation, public works, sanitation, libraries, and capital outlay. We also collected data on revenue and revenue by source, but there were no effects on these data, so I'm not going to really be spending any time discussing them. All of the data came from audited financial reports that were collected by hand. We also collected data that would speak more explicitly to this service solvency question that has come up a few times across a number of different panels so far, and hopefully tell us something about what actual government outputs and outcomes look like after bankruptcy. We settled on crime data for a variety of reasons, most important being that federal bankruptcy judges have explicitly referred to public safety in their decisions regarding Stockton and Detroit. We look at both crime rates, where we find little evidence that bankruptcy has a notable effect, but we also look at crime clearance rates, which is the ability of the government to solve crimes or make arrests in relation to crimes, the specific crime. Both of the data come from the FBI's crime reporting program, Uniform Crime Reporting Program, and then we also collected a bunch of socioeconomic and demographic data from the ACS, the BLS, and the Census of Governments. So next slide, please. So here we have a series of graphs that compare the raw data from non-bankrupt and bankrupt municipalities. The vertical zero line centers the data series on the year in which the municipality either filed for bankruptcy or the year that the control governments experienced their similar fiscal year to the bankruptcy. So all year-specific information has been removed from these data and been replaced with period-specific information based upon how far the municipality is from their acute fiscal event. We'll add the year-specific information back into the data once we run the analyses, which I'll talk about on the next slide. In general, we see that non-bankrupt municipalities, which are the red lines, generally spend less both before and after bankruptcy on all categories per capita, compared to municipalities that eventually filed for protection. Similarly, looking at the crime data on the right-hand side of the slide, you can see that non-bankrupt municipalities were also generally better at clearing crimes and that overall crime rates were lower. Next slide, please. The previous figures are just the raw data. They're unadjusted for a variety of things like year-specific trends and demographic differences. So we control for these things in an attempt to isolate the effect of filing for Chapter 9 protection. And we do this by using a staggered differences and differences model as well as an event study. The staggered difference and differences looks at the difference in one of our outcome variables, let's say per capita general fund expenditures before and after the year of the acute fiscal event. So for filing municipalities, the year is the year of filing. For non-filing municipalities, the year we're looking at for comparison purposes is the year that was matched to the year that the municipality was filed, that the municipality filed. So for example, if we're talking about Stockton in the year that it filed, 2012, compared to Sacramento in 2011, which is 1 year after 2010, or the year that Sacramento's finances and population looked most similar to Stockton in the year 2011, which was the year before it filed. I know it's a lot to wrap your head around, but we then look at that difference before and after the fiscal event and look at the difference between the difference in Stockton and the difference in Sacramento. If that difference in differences is large enough, we can conclude there was a significant effect associated with the act of filing for Chapter 9 protection.
You have about 2 minutes.
Okay. We also control for year-specific effects, municipal-specific effects, and all of our socioeconomic and demographic data that varies over time and place. While the diff and diff specification is good at telling us whether there's an overall average effect from filing, we also look at how these differences change from year to year. And we do this in an event study that also allows us to test a number of assumptions about the model, the differences and differences model, particularly about whether municipalities experience similar or parallel trends in the outcome of variables. And I'm not going to show you the results given our short amount of time we have here, but the key takeaway is that parallel trends assumption is generally satisfied. Next slide, please. So finally, we come to our main results. On the left-hand side, we have results from all of our spending outcomes. The 3 different categories of crime clearance rates are on the right-hand side. And I'm not showing you the revenues or crime rates because there's no statistically significant effects from this model, in this model. In terms of our spending outcomes, we see declines in per capita spending across the board for filing municipalities. The largest effects are on library spending, which declines about half a standard deviation after filing for protection, as well as public safety spending, which declines about 4/10 of a standard deviation. We also see declines in total and general fund expenses. They're smaller, not in absolute terms, but in terms of the variables overall variation in the data. The other categories are not statistically significant. The results for the effectiveness of the local police force, their ability to make arrests in relation to the crimes that have been committed, are quite striking, again on the right-hand side. In this model, we're actually controlling for the previous year's crime rates and spending on public safety, so we are really able to pretty well isolate the effect of municipal financial reorganization on the ability of the local government to solve problems for their constituents. We find that there is across all categories of crime clearance rates an improvement of about 3/5 of a standard deviation. So for violent crimes, local governments are making arrests at about 12 percentage points higher than they were before filing relative to other fiscally distressed localities. And just wrap up really quickly, what does this mean for fiscally stressed local governments? There's a few key takeaways here, we think. First, bankruptcy results in cuts to spending relative to other fiscally stressed localities. This is quite clear. We don't have granular enough data to say exactly where those cuts are coming from, whether it's payroll or deferred pension contributions. But another thing we can say is that those expenditure cuts may not actually have a detrimental effect on government performance, at least as it relates to public safety. And I don't want to overstate our findings, but I do think that it's an interesting result, particularly now in this moment of discussing the ramifications of defunding the police, that cuts in public safety were actually accompanied by improvements in public safety performance. There's likely some management story here that we don't have data on, what happened to these police departments before and after filing for bankruptcy. But we would really ultimately like to know is, are there places we might find similar patterns of government output and service solvency? Surely this isn't going to hold true for libraries. You cut library spending, you're probably not going to see an increase in books borrowing. But figuring out how to measure service solvency on dimensions other than public safety is a huge issue for us, and one we feel we've really barely scratched the surface of. So we'd love to really hear some more thoughts that you might have on this in the Q&A. Thank you so much for your time and giving me the opportunity to share the work with you.
Thank you. And now Kate Long from the Puerto Rico Clearinghouse is going to discuss this paper. You're on mute still, I think. You need to unmute. Okay. I don't think you're unmuted yet, Kate.
Am I muted now?
No, you're good now.
Okay, great. Sorry about that. Thank you all for having me. I want to say I don't read the academic literature on bankruptcy. For the most part, I tend to read the legal filings in the bankruptcies. But this seems to me to be a landmark work on municipal bankruptcy. It creates a framework or a paradigm for analysis when evaluating the decisions being made by the local government, or in the case of Puerto Rico, the oversight board, in terms of fiscal choices. There's no question that bankruptcy should improve outcomes for citizens, and your finding appears to support that promise by showing bankruptcy does improve service solvency. Although you've narrowed down on the crime data, I think you probably over time might want to look at some of the others. It really doesn't help bondholders to just cut the debt or reduce pension levels in the municipality or the public entity to still be a not very well run or a wreck. Bondholders need the certainty that they can be repaid over whatever period of time the debt is restructured to, and so you're finding that service solvency is improved is certainly a benefit for bondholders. By breaking out the per capita spending, pre and post filing is an excellent way to do analysis, and also again matching that to the crime data is excellent. I wanted to make a couple of suggestions where you might want to extend or look a little more closely based on my work following bankruptcies. There are cases like Detroit where the state makes contributions in the workout. In Detroit particularly, there was a pension contribution or the grand bargain deal. That will could make some difference in your per capita numbers. And more particularly, when municipal bankruptcies happen, the major work is done in adjusting pension and OPEB costs and debt service. So you need to back that out if possible in terms of the general fund per capita expenses. Because pre and post filing, you can have some pretty substantial differences. And that may be contributing to the decline that you're showing in the general fund expenses. That first chart, upper left chart you have on page. You know, we've seen in some cases, you know, debt service costs reduced substantially, and often for distressed municipalities, that's, you know, one of that and pensions are the primary burdens, fiscal burdens. Also, I want to point out that, you know, bankruptcy fees, the money that's being paid to the attorneys and the advisors is substantial for a lot of these municipalities. So the year of filing, you get a big hit to expenses, and then, you know, depending on the length of the bankruptcy proceeding, you get follow-on expenses that you might want to take a look at. Like, for example, in Detroit, the bankruptcy costs were about $200 million, and in Puerto Rico, we're at about, you know, we're at $1 billion plus now, and we're a long way from being done. Also, you know, just from this is not empirical, but just sort of my general understanding of governments and how they run. I don't know if there's a way to look at corruption in municipalities on a quantitative basis, but it just seems to me that many municipalities that have gone into Chapter 9 have substantial corruption problems, and there's also an element of union control where unions have often taken pretty strong control of the collective bargaining process and run up their benefits, both employment benefits and pension benefits. So I think that's about it. I just want to say great work. I really appreciate reading it. Anything I could do to contribute, I'd be happy to. And thanks for looking at an understudied area.
Thank you. Thanks. And I had a couple questions, not to get back to what you just said you talked about in the Q&A possibly, like the whole sample selection, and also if you could talk a little bit about your, like I thought your results were striking and I found this super interesting, especially on crime. But can you talk a little bit about sort of how much you think might be coming from the California folks versus the other places, and whether, I understand like you have 6 and now I'm basically saying, can you split the samples and look more closely at certain specific ones? Like, so the California ones, I always wonder if California is different. And so sort of thinking about them and how their results differ from the other places. The other one, and partly this might just be because I know it more than some of the other places, the Rhode Island one seemed really, like, it seems astounding to me. And I'm just wondering how much is Providence just excluded when you actually do the selection stuff? It just seems like it's so much bigger and is fundamentally different than Fall River. So can you talk a little bit about both those things, about sort of the samples and whether you think the California cities are driving this or not, and what you're expecting?
Sure. Thank you so much. And thank you so much, Kate, for your comments. Those were really great. So just about the question about the sample when we do the matching, we have created a number of different types of samples, a number of different control groups, and you know, everyone likes one more than the other for a variety of different reasons. So we have another samples, another control group where it's only out of state municipalities to control for contagion effects. And you know, people are concerned, well, the laws are different in those states, and there's too much of a difference between California and New York for you to make a reasonable comparison. But we have another control group that looks at only out of state municipalities. Then we have another control group. This is actually for a synthetic control, where we look at only states that, only municipalities and states that are not allowed to file for bankruptcy. So a number of different states have different rules about getting authorization from the state before they file. And then a handful, I think maybe it's just Georgia, that doesn't allow filing for bankruptcy at all. So we do have a number of different control groups. We're working on getting the data for those other 2 groups. It's a very intensive process, collecting the data by hand. So we're working on that. The initial results seem to suggest there's not too much of a difference in the results, but I can tell you more about that as we later. The other thing is looking at placebo tests and looking at sensitivity tests, and usually in these sensitivity tests, we just remove Detroit because it's so much bigger than the other treated observations. But we can certainly take a look at trying to remove California. Since it removes half of our observations, we're probably going to have virtually no power. But at least if the point estimates are similar, I mean, that says something, I think.
And I wouldn't necessarily, like, I would basically see what if you do the California ones separately and just see if their results are different.
Yeah,
But,
yeah.
We got a couple of questions. One asked whether the Chapel 9 samples were population weighted.
They were
and
not.
then how much confidence you have in the public safety crime conclusions.
They were very robust. So just in case you missed that, the Chapter 9 samples were not population weighted. We can certainly take a look at seeing how that would affect things. But in terms of the public safety conclusions, they were very, very robust and they were very strong, particularly compared to other types of spending. Similarly, on the crime clearance rates, I was incredibly struck by how strong the results were. So, I mean, if there are some specific thoughts about why we should maybe be a little more cautious about interpreting those results, I'd love to hear them. We'd both love to hear them.
I just want to add a little bit about the crime rate or crime clearance rate results. So yeah, I think that's probably the most striking finding that we have, particularly combined with evidence showing that there are declines in expenditures, right? And so that's a decline. I mean, you're talking about basically getting more for less, right? That's, most governments would want that. So what's going on here? So one of the things that we have seen, at least anecdotally, is some evidence in changing policing strategies. Stockton really went through this community policing initiative following its bankruptcy. And as Carolyn mentioned during the presentation, I think it's relevant that the bankruptcy judges really called out in Stockton and Detroit the violent crime rates as being examples of service insolvency, speaking to those governments' eligibility for bankruptcy itself. So the federal judges called out problems with crime, and lo and behold, these municipalities improved their performance. I don't think that that's unrelated. I think that it's possible that different management strategies are explaining at least some of what's going on here. Now, I don't have like a very strong and clear body of evidence to definitely for sure say that that's what's going on, but it seems to fit anecdotally. The other thing that I will say is that I'm not an expert on public safety service provision, but my understanding is that you can improve crime clearance rates for violent crimes if you invest in more investigative resources. So it's possible, let's say, to clear more murders if you're investing more in resources that are related to like lab results and investigation, things that you may not be able to dedicate time and resources to if you're just trying to get by, if you're really struggling fiscally. So it's possible that in addition to changing policing strategies, we're seeing within the budget reallocation of resources that comes with the space that Chapter 9 affords. Again, I don't have I can't say this is for sure what's happening, but these stories fit with what we observe.
Okay, so I had two questions. One, is it possible that other levels of government are providing some of the services that might be cut? Like, I'm wondering about if you think about if the county or state police is taking over some of the roles, if there are cuts in public safety. And then we have another question, and after you answer this, we'll just sort of wrap up. Someone's asking whether there are you can control for the different natures of Chapter 9 bankruptcies, like the differences between Jefferson County following legislators' refusal to renew the occupational tax versus others like Puerto Rico, which were driven by deficit financing. Were you able to do anything that sort of looked at the causality and how that fit into what drove in and what the results might be?
Let me just answer that question, and then maybe Akil can answer your question, Kim, about the state revenue and state expenditures. But so we did not control for anything about the cause of the bankruptcy or the fiscal distress. We were completely agnostic about the cause of these things. You know, we were interested in finding municipalities that were similar in the sense that there were similar on the things that were likely to predict bankruptcy. So even though, you know, like in Jefferson County, we don't have similar situations where other municipalities were having problems with their sewer, or as Kate mentioned, you know, a lot of these bankrupt municipalities have problems with corruption. So they're not similar in those dimensions. We don't have data, you know, that fine, that granular in order to match on these things. But we're hopeful that they're similar on enough observables that we can come to some conclusions about them, if that makes sense.
Yeah, so on the other question, with respect to other levels of government picking up the slack, so to speak. So empirically, we would control for this via the municipal level fixed effect. So if there are differences in service provision that aren't changing over time, those would be accounted for. What wouldn't be accounted for is, let's say, if the county decides to come in and step up their service provision in response to declines in the city's service provision.
And that's what I'd be afraid of. Like, there were the points where, like, Flint basically closed its jails and ended up using the county jails. We've heard stories about places, you know, when they've defunded their police, it was taken over by county law enforcement. Right? I don't.
So I looked at we looked at revenue, and I believe intergovernmental revenue was in there. I can double check, but there were no effects on changes in revenue or revenue by source.
Okay. Well, I will close the session. Thank you all for presenting some really interesting papers, basically about things that are going to be more present as we go forward, as I'm guessing that we will both see more local governments trying to figure out how they can restore their economic activities as we go forward after the pandemic closes and over the next couple of years. And then the cautionary tale and some of the, you know, there might be a silver lining if places are actually declaring bankruptcy and resolving some of their fiscal issues, and whether it actually could lead to more efficient services. On that positive note, I want to remind folks that at 10:15, we have another plenary that's going to focus on, I think it's on pensions. Yes. So pension sustainability and pensions that you will get to if you go back to the program, and you can click on the link there. So you don't actually have to register or sign in. It's just basically on the YouTube channel. Thank you all for participating, and thank you all for staying with us, even though we went a little long. And I hope you enjoy the rest of the conference.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.